Opendoor closed Monday at $7.05, down a little over 1% on the day, and while the move itself wasn't dramatic, the context behind the price action is more important than the number. The company finds itself at a moment where the market is trying to figure out what Opendoor actually is right now. Is this the early stage of a transformation? Or is it a warning sign of deeper structural challenges? And that tension is exactly why today's movement matters more than it looks on the surface. There was no major headline today. No SEC filing. No surprise announcement. What we saw instead was a stock responding to a broader set of forces: macro pressure, execution concerns, uncertainty around Opendoor's new strategic direction, and investor confusion about what Opendoor 2.0 really represents. When a stock trades without news but still carries volatility, that usually means sentiment is in flux. Investors are processing the bigger story rather than reacting to a single event. And the bigger story is this: Opendoor is no longer the company many investors still think it is. Under new leadership, the company is moving toward a lighter, more software-led model. Inventory is shrinking. Risk exposure is being recalibrated. The business is slowly shifting from a pure iBuyer into something more hybrid, part transaction platform, part AI-driven pricing engine, part real estate logistics arm. And any time a company changes its identity, the stock often stalls, because investors wait to see whether the transformation is real or just an idea. Today's price movement reflects that uncertainty. There are three major factors shaping today's action. The first is the lingering concern around Opendoor's inventory strategy. For years, the business model relied heavily on scale: more homes, more liquidity, more transactions. But now, with a tougher housing environment and higher capital costs, Opendoor has been reducing its inventory footprint. This is a double-edged sword. On one hand, less inventory means less capital risk and fewer balance sheet vulnerabilities. On the other hand, less inventory also means fewer transactions, lower revenue, and less data flowing into the system. Investors are still debating whether Opendoor can maintain the strength of its pricing engine without the same volume of homes running through the platform. The second factor is the market's reaction to Opendoor's recent warrant distribution. Warrants aren't inherently bad. In fact, they can be a tool for unlocking value, rewarding loyalty, or setting up future capital flexibility. But they also introduce dilution risk, and markets tend to dislike anything that increases uncertainty around future share count. Even though the warrants were expected, their long-tail impact on dilution is something investors are still pricing in. It's not causing panic, but it is creating hesitation. And hesitation, in a stock like Opendoor, often means mild selling pressure on quiet news days. The third factor is the broader housing narrative. Mortgage rates may be easing slightly, but affordability remains near multi-decade lows. Inventory across the country is tight. Consumer confidence in real estate swings week to week. And any company exposed to transaction volume is exposed to these fluctuations. What's relevant here is that Opendoor's business model amplifies both the upside and the downside of housing cycles. When housing is healthy, Opendoor can scale quickly. When housing is stagnant, scaling becomes more difficult. So even on quiet days, housing macro can create gravitational pull on the stock. But today wasn't just about concerns. The story just beneath the surface is actually more interesting. Because while the stock pulled back slightly, Opendoor continues laying the groundwork for a strategic transformation. The company has been pushing a narrative of becoming leaner, smarter, more efficient, and more tech-forward. Recent comments from leadership reinforce this. The message is consistent, execution speed is increasing, the product roadmap is evolving, and the long-term vision is much bigger than buying and selling homes. This is where the concept of Opendoor 2.0 becomes relevant. The pivot underway is subtle but important. Instead of simply being an operator that holds large amounts of inventory, Opendoor is aiming to become something more platform-like, a housing transaction infrastructure company. A company that uses data, AI, predictive modeling, and digital workflow to create smoother, faster, more predictable real estate experiences. A company where technology isn't a supporting act, but the primary driver of value. The bear case, however, is grounded in real concerns. Bears argue that pivoting doesn't guarantee success. Execution is everything. If transaction volume stays low, if margins remain thin, if consumer adoption doesn't accelerate, the transformation could stall. They argue that shrinking inventory reduces Opendoor's leverage in the marketplace and that competition from traditional real estate, brokers, platforms, and even marketplaces could limit how quickly Opendoor can scale a new model. Bears also point out that the company has not yet proven that its lighter model can deliver consistent profitability. The bull case sees it differently. Bulls believe that Opendoor's long-term advantage comes from three strengths that the market still undervalues: superior pricing data, a best-in-class transaction workflow, and a brand that is slowly becoming synonymous with certainty in a process known for uncertainty. Trades happen at speed. Offers can be generated quickly. Consumers get transparency. And Opendoor's data pipeline gets stronger every time someone uses the platform, whether they sell, buy, request an estimate, or explore options. Bulls also believe that the pivot towards software and services could eventually create higher margin revenue streams that reduce Opendoor's dependence on holding large amounts of inventory. Another important angle is that Opendoor is improving operational discipline. Costs have been cut. Risk management has improved. The company is making fewer but smarter acquisitions of homes. And structurally, Opendoor is better positioned today than it was during the overheated pandemic housing cycle. The key question is whether the company can translate operational discipline into growth during the next positive macro cycle. So what does today's dip actually mean? In one sense, not much. The stock simply reflected a quiet trading day where investors leaned cautious. But in another sense, it signals something meaningful. The market is waiting for clarity. Investors want to see concrete evidence that Opendoor 2.0 is not just a pivot, but a successful pivot. They want to see transaction velocity pick up. They want to see margins improve. They want to see the platform model develop. And until that clarity shows up in the numbers, the stock may continue drifting in either direction without a strong catalyst. But this moment also creates opportunity for those who view Opendoor through a longer-term lens. Transformations rarely move in straight lines. Amazon didn't grow linearly. Tesla didn't grow linearly. Netflix didn't grow linearly. Companies rewriting their own business models often experience volatility before inflection. The question investors need to ask is whether the groundwork Opendoor is building today will enable a stronger, more resilient, more scalable model in the future. This is why the bull versus bear debate is so intense. One side sees the end of the old model. The other sees the beginning of the new one. One side sees warning signs. The other sees early seeds of a platform that could one day dominate housing transactions. And that tension, pivot or peril, is exactly why today's move matters. For content creators and investors alike, this is the perfect moment to step back and evaluate the deeper business shift. Opendoor 2.0 isn't just about surviving the housing cycle. It's about trying to build something fundamentally better. A system where data replaces guesswork, where technology replaces paperwork, and where consumers finally get the level of convenience they expect in every other industry. So while today's price movement was mild, the narrative beneath it is anything but. Opendoor is at a crossroads. If the pivot works, the company could emerge as a leaner, smarter, more technologically advanced version of itself, one that is capable of scaling quickly when the housing market eventually strengthens. If it doesn't work, the company may face renewed pressure around profitability, liquidity, and competitive positioning. The next several months will be crucial in determining which version of Opendoor ultimately becomes reality. And that's the real story of the day. A small price movement, sitting on top of a very big question. Opendoor 2.0, pivot, or peril?